समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉपअप करा ले। दिस इज द राइट टाइम।
क्या? समझ में नहीं आया।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले। दिस इज द राइट टाइम।
अब समझा।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to The Print. This is Bidisha and you're watching Economics. About 8 months ago, I wrote my very first column for The Print titled, Why India Should Let the Rupee Fall. The rupee had just crossed rupees 88 to the dollar and I made what many considered a provocative argument. I said, stop defending the rupee. Let it fall deliberately, gradually, and strategically. Use the weaker currency as a tool to boost exports, create manufacturing jobs, and write India's own version of what Japan did in the 60s, of what China did in the 2000s, and what Korea did somewhere in between. The rupee's fall, I had argued, could be India's first step if managed right. 8 months later, the rupee has given me reason to return to this exact question. Same currency, same platform, but a very different crisis. Today, it stands at rupees 96.91 to the dollar, a record low. That is a 16.1% depreciation over just 18 months. It is being perceived as Asia's worst performing major currency for 2 years in a row. And the RBI has spent over $30 billion of our foreign exchange reserves trying to slow that decline. So what went wrong? And more importantly, where do we go from here? Because that is what today's explainer is regarding. Not a post-mortem, not blaming. This is a forward-looking prescription of what must India do structurally and decisively so that the rupee can never find itself here again. Let's get into the picture. Part 1. Why the $30 billion didn't work and what does that tell us? I want to start with a simple analogy. Imagine your car has a slow puncture. Every morning you pump air back into the tire. The car runs for a few hours, then flat again. You pump again, weeks pass and you spend a lot of money on air until someone finally asks, why don't we just fix that damn puncture? That is exactly what has been happening with the rupee. Look at this chart on your screen. This is India's foreign exchange reserves. Think of this as the country's savings account held in foreign currency, primarily dollars, peaked at $728.5 billion in the last week of February 2026. That is a number verified by the RBI data. By early May, they had fallen to $690.69 billion. That is a drawdown of over $30 billion in roughly 3 months. Now, what are foreign exchange reserves really and why do they matter? Simply put, when the RBI wants to support the rupee, it sells dollars from this reserve into the market. More dollars in the market means each dollar becomes relatively less scarce, which puts a floor under the rupee. Think of it like releasing water from a dam to manage the river's flow downstream. The RBI sold those dollars and the rupee still hit 96.91. This is not because the RBI failed, but because the forces pushing the rupee down were structural and not temporary. You can use reserves to manage the speed of a fall. You cannot use reserves to reverse the reasons for the fall. The $30 billion bought us time. But what matters now is what we do with that time. And that brings us to part 2, the trade deficit mystery. Here is something I want you to really sit with because it is the most important data point in this entire story. In the first quarter of financial year 2023, India's crude oil import bill was punishing. Brent crude, the global benchmark for oil, was averaging at $113 per barrel. This is extremely high. At those prices, India's quarterly goods trade deficit, basically the gap between everything we import and everything we export in goods, was $62.6 billion. Now let me explain what a trade deficit actually means in plain language. If India imports goods worth 100 rupees and exports goods worth 70 rupees, the deficit is 30 rupees. Now that gap has to be financed somehow, usually with foreign currency flowing in from other sources. The bigger the deficit, the more dollars India needs and the more pressure on the rupee. Now fast forward to the second quarter of the financial year 2024-25. Oil has come down significantly, averaging just $80 per barrel. That is a 30% reduction in the price of our biggest import. The trade deficit should have technically shrunk, right? But it didn't. It hit $83.2 billion, a record high. Even as oil was cheaper, we were importing far more electronics, gold, and capital goods, and these were growing much faster than our merchandise exports. Now, this tells us something profound. India's trade problem is no longer an oil problem. It has structurally outgrown the crude oil cycle. The gap between what we import and what we export in goods has become a permanent feature of the architecture of our economy, a design flaw, not a weather event. In my September column last year, I had argued that a weaker rupee would help fix this by making Indian exports cheaper and more competitive. Now that logic still holds, but here is what I would like to add today. A weaker rupee helps only if there are exports ready to benefit from them. If the manufacturing capacity isn't there, the weaker rupee just inflates your import bill without generating the compensating export revenue. Building that export capacity is now the most urgent task on India's economic agenda. Part 3, from patient money to hot money. Now we come to the second structural problem, and in many ways, it is the more dangerous one. It is about the kind of money financing India's economy and how that mix has shifted in a worrying direction. Look at this chart on your screen. I want you to think about two types of foreign money that come into India. The first type is what I would like to call patient money. This is the foreign direct investment, or FDI. When a company decides to build a factory in India, set up a supply chain, hire workers, and make a 10 or 20-year bet on India's future, that is FDI. This money does not evaporate overnight. It creates jobs, it builds capacity, and it is anchored to the real economy. Now, the second type is what I would call as hot money. This is the foreign portfolio investment, or FPI. This is a fund manager sitting in New York or Singapore buying Indian stocks or bonds on their screen. It is fast, mobile, and follows market sentiment. On a good day, it flows in. On a bad day, for instance, a geopolitical shock, a Federal Reserve rate signal, a crude oil spike, it flows right back out. Now look at what happened to India's capital mix between 2021 and 2026. In the financial year 2021, India had a healthy balance. Patient FDI money was around $38 to $39 billion. Hot FPI money was around $36 billion. Together, they more than covered the trade deficit. That is a stable and sustainable position. By the financial year 2024, something had quietly shifted. FPI had grown to $40.7 billion, boosted by excitement around India's inclusion in global bond indices, but net FDI had collapsed to just $10.1 billion. India had effectively begun swapping stable, productive capital for volatile, sentiment-driven capital. And by 2025, verified by RBI data, net FDI had crashed further to just $0.4 billion. This is not a typo. $0.4 billion in net long-term investment in an economy of this size. Then came 2026. FPI recorded a net outflow, money leaving India of $15.5 to $16.7 billion depending on the data series, the largest portfolio investment withdrawal in years. March 2026 alone saw FPIs pull out over rupees 1.14 lakh crore in a single month, the highest ever monthly outflow on record. Think about what this means. In March 2026, foreign investors were selling Indian stocks and bonds at the rate of roughly 4,000 crore rupees every single working day. Every rupee they sold, they converted to dollars, directly adding to the pressure on the exchange rate. This substitution, patient money replaced by hot money, is the central structural vulnerability. And the good news is, this is fixable. India remains a genuinely attractive destination for long-term capital. But unpredictability costs us dearly. And predictability is definitely a governance choice. This brings us to part 4. 3 decisions India cannot keep postponing anymore. So where do we go from here? I want to be specific, not vague policy recommendations, but 3 concrete structural decisions. Decision 1. A national commitment on exports. India needs a formal public goal to reduce its goods trade deficit as a share of GDP. And I want to be clear, this cannot be through import restrictions itself. Raising tariffs makes inputs more expensive for Indian manufacturers, invites retaliation from trading partners, and ultimately harms the very industries we are trying to protect. The only sustainable path is to build exports. Real, scalable, globally competitive goods exports. Again, going back to my September column, I had pointed out that India's share of global goods exports is under 2%, roughly where it was during independence, even as our services exports have grown impressively. That gap between the success of services and the failure of goods is the opportunity. The PLI scheme, Production Linked Incentive, is just a beginning, but not a complete strategy. A strategy requires answering one honest, difficult question at the top of the government. What can India manufacture that the world wants to buy at scale, and what do we need to do to make more of it? Until that question has a credible, funded, sustained answer, the rupee will remain structurally exposed to commodity cycles and global mood swings. Decision 2. Make India predictable for long-term capital. Every time India introduces a retroactive tax, applying new tax rules to investments already made in good faith under old rules, it tells global investors the rules can change mid-match. Every sudden policy reversal in a sector, every regulatory shock that disadvantages a foreign investor, each of these adds what in economics we would call a risk premium to the cost of investing in India. What is exactly a risk premium? It is the extra return an investor demands to compensate for uncertainty. The higher the risk premium, the more expensive it is for India to attract capital, and that cost shows up quietly, persistently in the exchange rate. RBI data confirms that net FDI in 2025 was $0.4 billion. India needs at least $10 to $15 billion in net FDI annually to replace the volatile portfolio capital it is losing. Every budget decision, every regulatory announcement going forward must be evaluated not just for its domestic political impact, but for the signal it sends to that long-term investor in Singapore, Frankfurt, or Toronto who is choosing between India, Vietnam, Indonesia, and Mexico. This is a governance challenge. It is not about giving away India's economic sovereignty. It is about being consistent, transparent, and reliable, qualities that attract the patient money India actually needs. Decision 3. A transparent framework for the RBI. Now, the third decision is the least glamorous but potentially the most durable in its long-term impact. What the RBI needs is not a target exchange rate, Dr. Geeta Gopinath has correctly argued that the rupee must function as a shock absorber, and you cannot help a shock absorber by nailing it in place. What is needed instead is a published rules-based intervention framework. Let me explain what that means. Right now, when the RBI intervenes in the currency market, markets don't fully know the logic. Is it defending 96 rupees? Is it defending 97 rupees? Is it reacting to speed of movement or level? This opacity creates uncertainty, and uncertainty in financial markets tends to amplify volatility rather than reduce it. Countries like Chile, Brazil, and Indonesia have published clear intervention principles. We intervene to prevent disorderly market conditions, not to defend any particular level of exchange rate. That distinction, intervening against disorder, not against direction, is very crucial. Markets can work with it. Speculators find it harder to bet against a central bank that is transparent about its limits. And alongside this, India urgently needs to deepen its onshore currency derivatives markets, essentially the financial tools that let Indian companies hedge or insure themselves against exchange rate swings. Right now, if an Indian company has borrowed in dollars and the rupee weakens by even 10%, their loan repayment in rupees just went up by 10%. And there is very limited domestic infrastructure to protect against that. A deeper hedging market would mean that the exchange rate no longer has to bear the full shock of every global turbulence. Now let me bring this back home. India's economic fundamentals remain strong, the growth drivers are real, the digital infrastructure is genuinely world-class. The services economy is a good global success story. But every additional percentage point of rupee depreciation has costs that ordinary Indians feel directly. A higher import bill means higher petrol prices, higher costs for manufacturers, more expensive electronics and medicines. It adds to the rupee denominated cost of servicing India's $682 billion in external debt. It constrains the RBI's ability to cut interest rate when businesses and households need relief, because cutting rates while the currency is under pressure risks accelerating the very outflows we are trying to stop. The global environment may yet offer India a window. A US Federal Reserve that finds room to cut rates, a de-escalation in West Asia, some easing of trade tensions. If and when that window opens, the question is whether India will use it to build new foundations or simply breathe a sigh of relief and return to the status quo. 8 months ago, I argued that the rupee's fall could be India's first step. If it was managed the way great export economies had managed currency weakness before us. That argument still stands, but the word I keep returning to is managed. And management requires structure, it requires transparency and the political will to make decisions that are difficult in short run but decisive in the long run. The RBI spent $30 billion of India's hard-earned reserves buying us time. Let's use the time. The rupee does not need a defender. It needs an economy that is worth defending. And building that economy, that is the work that starts now. Thank you for watching.